So, how do massive companies decide where to place their bets? We're talking about these huge multi-million dollar decisions that can literally make or break their future. Well, today we are going to pull back the curtain and see exactly how those giant capital investment decisions get made.
I mean, really think about it. How do they decide whether to drop a fortune on a brand new factory or launch a wild new product? It's not just a gut feeling, right? There's a really rigorous process to figure out if a project is actually going to create value. And that's exactly what we're going to walk through together.
And to make this all feel real, we're going to follow one project from the spark of an idea all the way to the final decision. Our mission, should we choose to accept it, is to decide whether our company should launch a brand new shark attractant. Yep, you heard that right. Let's see if this fishy idea can actually swim.
Okay, so before we can even start crunching the numbers for our shark attractant, we have to establish the rules of the game. And the single most important question we have to answer is this: what cash actually counts when we're making the decision?
This right here is the golden rule: incremental cash flow. It means we only, and I mean only, care about the cash flows that happen because we take on this project. It's all about the difference between the company's future with the project versus its future without it. If a cash flow is going to happen anyway, guess what? It's totally irrelevant. And that brings us to our first major rule of what to ignore: sunk costs. Look, a sunk cost is just money that's already been spent. It's gone. You can't get it back. Let's say we spent, $10,000 last year on market research for our shark attractant. That money is gone whether we launch this thing or not. It's in the past. So for the decision we have to make today, it is completely 100% irrelevant. You cannot let past costs cloud a future decision. It's a trap. Now, let's talk about something we absolutely must include: opportunity costs. This is the value of the best alternative that we have to give up. So let's say our shark attractant project is going to use a warehouse the company already owns. Now, you might be thinking, great, no rent, it's free. But is it? No. We're giving up the opportunity to sell that warehouse or rent it out to someone else. That lost potential income is a very real cost of our project, and it absolutely has to be counted. So to pull it all together, this slide lays out our framework perfectly. On one side, we have to include things like opportunity costs and any side effects. Like, what if our new shark attractant steals some sales from our old shark repellent? That counts. But on the other side, we have to be disciplined and completely ignore sunk costs and any financing costs like interest payments. We're focused purely on the cash generated by the project's assets, not how we paid for them. All right, with our rules of the game in place, we can finally start building the business case. It's time to forecast the future of our little project. And we do this using something called the standalone principle. Now, this is such a powerful idea. We're going to treat our shark attractant project as its very own mini firm, with its own revenues, its own costs, its own assets. This lets us analyze it in total isolation, completely separate from all the other stuff the parent company is doing. So this slide shows us how we build that mini firm on paper. This is what's called a pro forma, or a projected income statement. We're forecasting sales, 50,000 units at $4 a pop. Then we subtract our costs, we subtract something called depreciation, we calculate the taxes, and we arrive at a projected net income of about $21,000 per year. This is our first peek at the project's potential profitability. But, and this is a huge but, here's where so many people get tripped up. Profit is not the same as cash. Net income, well, that's an accounting number, and you can't spend an accounting number. We have to translate that profit into actual spendable cash flow. Honestly, this is the most important step of the whole process. The key number we need to find is the operating cash flow, or OCF. This is the actual cash that gets generated from the project's day-to-day business. The simple formula is to take our earnings before interest and taxes, our EBIT, add back depreciation, and then subtract the taxes. Now, why do we add back depreciation? Because it was a non-cash expense. No actual money ever left the building for it, so we add it back to get to the real cash flow. And what's really cool here is the consistency. As this slide shows, there are actually 3 different ways you can calculate OCF: the bottom-up, the top-down, and the tax shield approach. Yeah, they look different, but they're all just rearranging the same pieces of the puzzle. It doesn't matter which path you take, you will always get the exact same correct answer. It's a great way to check your work. So the crucial point is, after we run the numbers for our shark attractant project, we find that the annual operating cash flow is $51,780. This number, This is the cash engine of our project. It's the money it's going to spin off each and every year, before we account for any of our big initial investments.
Okay, this brings us to the final stage, the grand finale. We now have all the pieces of the puzzle. We know our initial investment costs, and we know the annual cash flow the project will generate. It's time to put it all together and calculate the project's total value. Let's get to the verdict. And here it is, the complete cash flow picture. At year 0, right now, we have our big cash outflows, 90 grand for equipment and another 20 grand for something called net working capital. So a total cash out of $110,000. Then, for the next 3 years, we get that sweet $51,780 in operating cash flow coming in. And check out year 3. We get to recover that $20,000 in working capital when the project ends, which gives our final cash flow a nice little boost. So this is it. This is the moment of truth. We've laid out every dollar coming in and every dollar going out over the project's life. But after all this work, after all these numbers, does the project actually create value for the company? Does it earn more than the 20% return we require? And the answer is yes. The net present value, or NPV, is a positive $10,648. So what does that number actually mean? It means the project is expected to generate returns that not only cover our entire initial investment, but that also exceed our 20% required rate of return by over $10,000 in today's money. This thing is a value-creating machine. So after all that analysis, the debates, the number crunching, the verdict is in. The shark attracting project is officially a go. We're moving forward. You know, this entire process, it really just boils down to this one simple idea. The goal in project evaluation is to compare the cash flow from a project to the cost of acquiring that project. That's all we did. We figured out the cost, we figured out the cash flows, and in the end, the cash flows won. This is such a powerful framework, and not just for big business decisions, but for your own life too. So, as we wrap this up, I want to leave you with a question to think about. What sunk costs, those past unrecoverable expenses in time or money or effort, what sunk costs are clouding your next big decision? Really think about it. Thanks for tuning in.